Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited to be joined today by Wayne Courreges III. Wayne, welcome to the show.
Hey, thanks for having me, Whitney.
Yes. Before we dive in, we are going to talk about today Majestic Apartments, 44 units in Houston, Texas, specifically the Galleria area. But before we talk about that property, tell us a little bit about yourself, how you got into multifamily and where you're at today.
Yeah, so I've been in the industry, be 17 years in June. So just high level, went in the Marine Corps 2003 to 2007, got out, was given the opportunity to work with the Fortune 125 company, CBRE, where I was there with them for 16 years. I was in Washington, D.C., Houston, Austin, then back to Houston. But I started our real estate investment company in 2019, focused on multifamily. So for a couple of years there, a few years, I was working, focusing on taking care of our clients with CBRE and doing that. And then working as well on our real estate investments, mostly weekends and nights and stuff. I always say that the 9 to 5 paid for the 5 to 9. But it was getting to a point where our portfolio was getting sizable, where it was hard to do both. And so in July of 2023, went all in. So I know your show talks with a lot of operators, and happy to go if there's any time to talk about working the W-2 and also doing your syndication business, because it is a lot of work. But it can be done, and it can be scaled at a point where at some point you can have that smooth transition. So it's a little bit about what we're doing.
Awesome. Well, I'm so excited to tap into your knowledge and expertise here today. So let's dive in. Majestic Apartments, 44 units in Houston, Texas. Let's start off. When did you close this property, and what was the purchase price?
Yeah, so we closed in October of 2023. With the purchase price, because it's a Texas non-disclosure state, I won't say exactly what the purchase price was, but it was about $1 million less than the tax appraised value. And I would say if you're ranging from 0 to 5 to 10 million, 5 million, it would be under that 5 million spot. So we bought this property. Typically, we buy 100 units plus. That's more of our portfolio and our go-to, but we have a property about a mile away. That's 101 units. And so when we were approached about Majestic, that was an opportunity to have some efficiency of scales and really, provide our investors and ourselves an opportunity to get at a good price, but also have that operational efficiencies between properties.
Excellent. Well, I mean, it kind of seems like a no-brainer, right? Like if you already have the systems, which I'm sure is part of the, how you were able to scale, right? Like your multifamily, while still working. But before we tackle that question, let's, kind of back up the time clock a little bit. So you closed in October. When did you find this deal, and how did you find it?
Yeah, so we approach finding deals two ways. One is going to the blue ocean route, finding off-market opportunities through, Secretary of State websites, appraisal district, finding true owners, finding their numbers, texting. And the 101 units that I told you about in the gallery that that we manage along with Majestic, that one was bought strictly from a text to a seller that we grew that relationship over 2 years, and they eventually sold it with us. This one was more of the broker relationship. And as time initially, when people get into this space, brokers send deals to people that really sometimes you just need a question like, why is it coming to me? Like, why am I getting this deal? And you're sort of talking yourself out of like why this deal just may not work. But as time goes on, when you show that you can close deals and that you're good to work with, that you take care of the broker, there's I don't want to say collaboration, teamwork, et cetera, but those relationships are built, then you start getting into deals that come your way. And you don't have to be as pessimistic, like, why are they sending me this deal? Why didn't they send it to, these other people that they have worked with previously? So that's sort of where we're coming at with this deal. It was not on market, though it probably was distributed out to many buyers or potential buyers through this broker. But it came to us, I think, in January of 23 when we first looked at it. The property management company was the same management company that was doing our other property, and the price that they were looking for at that point didn't really fit our model or fit our underwriting. And then it came back like 6 months later, 7 months later, that we started really looking at it again and seeing, okay, well, what efficiencies of scale could we use to find an opportunity? It was, the property itself was in good shape. It was, really well leased, had great Google reviews. And so even though it was smaller, I was becoming more open-minded to being like, okay, well, this could be a really good opportunity.
What was the vintage of the property?
Great question. It is a 70s property.
Okay. And then what's your overarching business plan thought process with this? Like a value add strategy?
Yeah, so it was already cash flow. Like we've already sent our we bought in October, we sent our first distribution in February, and so we'll continue doing the distributions. This is one that the prior owner, took really good care of. I think the prior management company did, an overall good job as well, bringing in the right tenants or residents, and keeping with good residents, they're good paying and such. So it's more for us, it's turning, I always like to think of properties sort of like ships. And so you just turn in the ship direction slowly. So maybe over 2 to 3 years, we're trying to get those rents that were way below market rents to market, right? But we want to save the community. There are some properties that I have bought that, like, man, I don't want to save this community because this is not a good place for children and people to be living in. So that's a different business plan. This one was, there's already a great community here. There's already, they know each other. It almost has like that Melrose Place feel to it, right? And so, if they're paying rent on time and they're taking care of the property and they're just overall good citizens, good people, then it's like, let's move the needle more slowly so we're not having a higher vacancy, having that turn, et cetera. So the business plan is just to continue the operational aspect of, as renewals happen, there'll obviously be some rental increases, but there'll be, when there's turns, we'll do some renovations. But I'm not one of those owners who's like, hey, let's just raise rents, even if we're way below market, like let's just raise rents. I mean, that's doable and it's possible, but there's a perception aspect. And the perception aspect is that you're going in and you're adding value to the property as the new owner and adding amenities or doing things that the property needs. So for us, when you walk in, you think of it's like four buildings sort of in a square, and then you have a courtyard in the middle. It was pretty barren. Like it was a lot of weeds, a lot of grass. There was some charcoal grills. There was nothing to really excite you about the amenities. Mm-hmm. So what we did is there was a lot of areas that had like rocks and stuff. We put in some green turf. We want to make it low cost operationally in the future. So we spent money up front on the turf to add some greenery. But then we also added a bike rack. We did a nice gazebo, and the gazebo is from Costco. And we put the gazebo up and then did a grill area. One of the complaints too was like the washer and dryers, they were having issues with the maintenance. So we bought that contract out and put our own washer and dryers in and really try to just bring up the property from an amenity standpoint. The stairwells were all rusted, like the railings, it was pretty rough. So we made that as like a focal point where, cleaned them up, painted them black. And so now it's just a lot cleaner and nicer. It has more amenities. Then when we can start pushing rents over that, 2-year period or so, it's like something's tangible. They're paying a little bit more, but they now have a nice seating area and a grill area. They don't have to worry about, is the washer not going to be working today because, of just poor quality washer and dryers that were there. So
I hear you. Well, so at what point in time did you walk this property? So it sounded like you found it in January. That was the first introduction to it. And then 6 months later, you had a second kind of like, hey, are you sure you don't want this property?
yeah.
When did you decide to walk the property and put in an offer?
I think it's probably like July, August timeframe. We put in the offer, we negotiated, good terms. It was nice that the seller was really, like we got on a call with the seller and the broker, and it was a very good, cordial relationship from the beginning. Um, they were a large REIT and were looking to offload this property because their concentration in Houston, uh, they only had this one property in 44 units. And those that have like smaller properties, it's hard to maintain and, from and really cash flow that type of property when you have, you don't have the efficiencies. So when they sold it, we did a negotiation of seller financing. So there was a piece to this that was unique in that this property was free and clear on cash. So we were able to
Ooh.
negotiate a fixed seller financing deal. And so when that started happening, like July, August, we started looking at that. And again, I'm always trying to find ways for reasons not to buy a property. It just I really try, like I'll even underwrite properties and I'm like, okay, well, maybe I need to be more conservative and stuff. And at some point you can't stay on the sidelines forever. You got to jump in, right? There's that piece. But as I was going through this, I was like, man, this really is a great asset, good bones. And I said it was a 70s property, but it's actually a 60s property. Um, and typically I wouldn't buy a 60s property, but the piping was PVC. Normally in 60s you have cast iron piping, like PVC piping. The roofs were in great shape. HVACs were in good shape. They were all sub-metered or electrical boxes, no stab block breakers or Federal Pacific. So there were a lot of things that were like, yes, it's a 60s product, but it has 70s, 80s type mechanical, electrical, plumbing type equipment. So
Well, so let's talk about the offer. And thank you for, touching on the due diligence. And we'll kind of, wrap that up. But I want to make sure that we understand, how did you get to the offer? Were you the only group looking at it? If you were, how did you structure your deal?
yeah,
And, how many days for due diligence, closing, any extensions here?
yeah, sure. So typically I mean, it's pretty cookie cutter for us. I mean, we have like a 2-page letter of intent, and we a lot of people go in with this. And when I first got started, like 5 years looking at properties, I sent letter of intents that were multiple pages, and really that's there's a time and place for that. That's during the contract purchase selling agreement, but for the LOI, it's just high level, not to scare anybody away or anything. Let's just get to the deal points. So the deal points obviously was purchase price, seller financing. Those are things that were already worked out before we even did the letter of intent, because I was talking with the broker, and then I told you we had a call with the seller, which is very unique. Normally, and I don't always recommend having those conversations with the seller. Let the broker be that middle person, because sometimes emotions and it just let the broker do their job, right? But in this case, that's how we did it. So we just did the offer. Of course, there's earnest money. This is a deposit. There's usually 2 weeks of due diligence before the money became hard. Once the money becomes hard, it's unless the seller runs the property in the ground or doesn't do what they're supposed to, or there's environmental or something, then we get that money back. But when it's hard, it's risk. That's just part of this business. And we did our due diligence for 2 weeks. The extensions on the LOI, I believe, were negotiated at 10,000 each extension. So we would have like a
And what
normal
was the
six.
original earnest money then?
Yeah. So usually we look for like 1% of the purchase price is usually a good rule of thumb. And then of that 1%, that gets you, 60 days to close. And then, every deal is going to be a little different. But on this one, I recall I did 10,000. I think I initially did 5,000 per extension. I think it went up to 10,000. Pretty sure it went to 10,000 per extension. We did use those extensions. Last year raising capital was extremely tough. And what I find too is like sometimes with these smaller properties, it's even harder to raise capital for, because they're not the 100, 200 plus units, with all these great, fantastic amenities. So we did use those extensions. We closed, and everything was fine. But Anyway, so that's that on the letter of intent. It's just, purchase price, sort of earnest money. That's always important. Putting your best foot forward, usually 1% of purchase price. And then your inspection period, and everything overall, I mean, knock on wood, it went really smooth. I mean, going back to our due diligence during our period, we have property management review the underwriting, make sure that they're comfortable with executing. They're in this process early on, but then we pay electrical, plumbing, roof, HVAC. We do all the due diligence, run the cameras through all the plumbing lines, et cetera. So that's all part of it. So that's in that 2-week period, and then you also have your lease audits as well. So a lot happens once you get that deal signed from a letter of intent, and then that contract that gets you into due diligence.
And then anything pop up on the financial due diligence, like the lease audits, were all the rents in line, were all the tenants paying?
Yeah. So one really nice thing, not all deals are like this, right? But all the tenants were paying online. And so that was super nice because it was easy to see and track that, like, one, there wasn't an on-site manager, and that manager previously had trained or gotten their residents to fully utilize the online system. So that was nice. They also had everything in digital format. So a lot of times, you got your physical paper leases. They didn't, they had everything online. So we went through it. Again, it was from a transparency standpoint, I think the seller did a really great job of, being transparent with everything. And then I think the management company, from an organization standpoint, they made it easier. Now we do have a huge checklist of all the things that we need to see. Typically in the last 3 years, we'll want to see all the financials. We'll want to see, delinquency reports, obviously the T12, but we'll want to see utility billings, and obviously the leases, and really just don't. And it's nothing like personal, it's not like we're trying to say they're liars, but you got to trust and verify, and because you don't want any surprises. And one other thing too, and it wasn't at this property, it was another property, is checking with the city of Houston to ensure there's no habitability concerns. Like there wasn't a previous inspection that was done that they haven't completed or fulfilled. So that's another item during due diligence. It's just important to make sure there's nothing outstanding, because those can definitely eat into your capital that you didn't plan for if you didn't check to see if the city, has a outstanding code violation.
Mm. And that's something that's not brought up often enough here, but I'm curious, whenever you say habitability, did you have tenants that were on some sort of affordable housing program or something like that? Is that why they were involved?
Nope. So in the city of Houston, most cities, they won't have annual inspections, but usually like every 3 to 5 years, they'll have an inspection. And
Got it.
so,
Yeah.
yep. And that inspection that happens isn't really more so about like deficiencies today. Like maybe your stairwell, for example, is in overall good condition, but they start seeing rust spots, and they're like, okay, well, this over the next 5 years can accelerate and cause issues or safety concerns. So we're going to cite it, and we want it fixed now, because over the next 5 years they may not come back. So so that's another thing too to just be considerate of. Usually the bigger ticket items, what I've been noticing is like the landings of the stairwell, and then if you see the little pinpoint holes in the stairwell metal framing, those are type of things that it's the right thing to do to address it so it doesn't become a long-term, more expensive issue down the road. But those repairs, especially if you got to get a structural engineer involved, those are things that the city may require. And if that inspection was done, one, they should have disclosed that to you. But if they didn't, again, don't assume and don't expect that they're always going to do the right thing. Call the city, go to the website, just make sure there's nothing outstanding on that piece.
Great point. Great point. Now, I want to make sure we have plenty of time to get through the a few other questions that I have here. So let's dive into the financing. You said you did seller financing on the deal, and the seller it was 100% paid off property. So I'm curious, how did you structure this?
Yeah. So first off, deals happen in any markets anytime, right? So if you have the mindset of like, hey, there's no good deals out there, then there's not going to be any good deals. There's not going to be able creative thinking, et cetera. So that's where this, creative thinking, creative financing, like obviously the seller would have preferred to do free and clear, and just had a new loan, and they don't have to worry about the property any further. But with the hike in interest rates, and because they're wanting to close and we wanted to buy, it you make those creative opportunities when you have the mindset like, hey, there's good deals, we can make this work. So with that said, that was not initially on the table with seller financing, but we brought it up, we had those conversations, and we got it to the point. But really, it makes sense for them too, because they, even though we bought it less than what they purchased it for, and then substantially off the tax appraised value, they're still getting six-figure interest payments for the next 5 years. So when you collectively look at that, they're still making a return on their investment, right? And so talking with the seller and be like, hey, there's, I mean, I didn't have to do that. They were very sophisticated and they got it. But for some people who maybe are dealing with more mom and pop, maybe they own the property, but there won't be the tax hit day one for one piece. They still have the earnest money and, the property, continuing to do rents. There's still a physical asset. So if the loan defaulted, there's still an asset that protects them, that they can protect their investment or their loan. The other thing too is one of the deal points on that loan was that we needed to put at least $200,000 into capital improvements over the first 2 years. And so that was a little negotiation because I believe they wanted like 250 up front, or maybe it was like 280, but we got it down to 200,000. And so, but we've done 80,000 of that so far. I mentioned the gazebo and the bike area, laundry. We've done a lot of the painting. And now it's just like really the interior unit renovations. But anyway, from their standpoint, I don't think what they were trying to do by making that negotiation point, and I think it was really smart of them, is to ensure that we, as the new owners, are improving the asset. That, even if we were to default, and we don't have any plans to, the DSCR is very healthy, et cetera. But they don't know us. They don't know if we're good operators, they have no idea. So they're protecting their asset, and their collateral for the loan, right? So,
well, if you did default, you've already pushed the value of the property for them,
yeah,
right?
yeah,
And
yeah,
that seems like it
that's
could
right.
be a good negotiation point for people that are listening, that are trying to figure out, hey, how do I get somebody right now in this market to entertain a seller financing, right? You've got, that clause you could put in there, and that they're automatically pushing value. There's even I want to bring up the point that, by the seller taking a payment distributed over a period of time can help them reduce their taxes.
Right.
So, because they're not getting one lump sum, especially if they have the property paid off in full.
Absolutely. Yeah. So I think all really worked out well for them. And worked out well for us. It was a win-win. It is hard. I don't see a lot of like the larger multifamily where they own it free and clear. That's one of the, benefits of
Try
owning
not to.
multifamily is you can refinance, you get like
Yeah.
but they are out there. But what I do see more in this market, Whitney, is more loan assumptions. So we're looking at a deal right now that, has, below 4% rate with 5 years left, and that's a loan assumption. So, again, you're just looking at, yeah, the interest rates are high, but how do you, when I say high, historically, they're not that high. It's just we were so used and spoiled with such low rates, that, we'll see what happens in the future. But going back to, if you have the mindset that you can find deals and you can be creative and you can get deals that are cash flowing to your investors, make them happy to continue growing all together, there are those opportunities in any market.
Awesome. Well, I want to move on to the capital raise,
Yeah.
as we wrap up here. How did you structure this deal with your limited partners, and then also with the other general partners? Because we were talking before the show, there's a couple other general partners in this deal.
Yeah, for sure. So we do, majority of our deals are 75% limited partners, 25% us. And how we structured is the first 8%. Every deal is going to be a little different, potentially. But for this deal, what's been consistent is for the first 8%, it's 100% our limited partners. So the first 8% that the property produces in cash after net operating income goes to our investors. And then anything from 9 to 18% is split 75% limited partners, 25% us. And then anything over 18% is split 50-50. So from a limited partner, that's sort of how it's structured. It really, in my opinion, aligns it really well, because my goal is to make our limited partners as much money so that they can feel confident telling their friends, et cetera, and reinvest in other deals. So that's that piece. It also makes the carrot. So I make you as much money as I can through the property. Then I'll benefit from that after I'm hitting those returns, right? So that's how that is how it's structured on our limited partner piece. On the general partner side, so it's really split being on what, if you think of the pie, so say it's 25% of the general partnership. And of that 25%, you think of it as a 100% pie. So we're just looking at 100% of the pie of that. Typically, what I would see is, if you're signing on the loan, if you're finding the deal, signing on the loan, that could be 10% each. So you find the deal, maybe that's 10% of the deal from a GP stack, maybe another 10 to 15% for the liquidity net worth. That takes care of, that'd be 25% of the deal right there is finding the deal, underwriting, getting under contract. And then you got your net worth, liquidity, possibly your earnest, somebody, if you don't have the earnest money, bringing in someone for that. And then we typically see about 30% allocated towards, raising capital. The biggest thing on this, and where I think people just need to be very careful of, is that you're not able to pay capital raisers and just have the capital raisers go off in the sunset. So we have weekly asset management calls, and our GP members are on those calls weekly. So they are, and, we do the management company keeps roll, so that way there's proper paperwork and stuff. But usually about 30% of that GP is allocated to capital raisers. Then you have the asset management piece as well, which is 20-25%. When you're first starting out, Winnie, though, like your piece, you may have found a deal, and your piece at the end of the day may have found this great deal, but you only own like 8 to 10% of the GP for that, right? Because you had to bring in other people. You're the quarterback. You had to bring in other people to get you to close that deal. Over time, though, we are owning more of that pie. And I think that's the goal. I love the team approach. I think I would welcome those co-GP members out there that are wanting to partner with an experienced operator and a group like us. Like, would love to welcome those calls and passive investors, et cetera. But over time, too, like, we will have the net worth to sign on the loan. Like for this particular deal, we had the net worth and liquidity to sign on the loan. We didn't have to bring in outside people, right? For that piece. We paid the earnest deposit. I didn't have to pay someone else to bring in their earnest deposit money so we can get the deal under contract. We found the deal as well. So we owned a little bit more of that, where we were looking more for the help, and we're very active asset managers. We don't raise capital for other people's deals that we're not involved with on the asset management and just heavy boots on the ground. We don't do fund-to-fund models or anything. Like we're active operators. So when it comes to like the capital investor or capital partners, instead of them joining, but then they get to participate on the asset management side is pretty key, for them and us. And then as we grow, we'll continue to, try to own more of that GP split from a CREI partner standpoint.
All right, just a couple more questions here. What, on the GP side of things, what fees did you charge the deal?
Yeah, so for the acquisition fee, for this one was 3% because of the purchase price. Typically, we range it from 2 to 2.25% of the purchase price. And then we'll have typically a KP fee of 1% for whoever's willing to, sign on the loan and have that liquidity or that exposure. Asset management ongoing is 3% as well for this deal. Again, it's just because it's a small, 44 unit property. So we did that, but typically we do 2%. Anything over 100 units, we'll typically do 2%. Construction management fee, just us managing the renovations, interior, tracking expenses, insurance, lien waivers, payments, etc., is 5% of the construction management side of that. Um, and that's it. So, it's really, there's a lot of time. So I do this full time. I don't have any other side job anymore. Like this is full time. So there are months where I won't go without salary or anything until we find that property. And in fact, like I'm about to put 100,000 into earnest money that is completely at risk if we decide not to close. That 100,000, mind you, I'm not getting any money, unless I close a deal, and I'm paying out 100,000 for the opportunity to have a property that may get to the close line. Like there's a lot of risk there. So I'm of the believer, when you hear the 2-3% acquisition fee, and it's like, oh, there's a lot of money. Really, it's not a whole lot of money, because if they have an operation like we do, where you have employees, you have lights, someone in an office, you have a professional investor portal, you have the money that's risk that we're putting up before we go to our passive investors. We are paying for the due diligence costs. We pay for the due diligence costs. And if we decide to walk away because there's plumbing issues or roof issues, that's potentially 15,000 for all the inspections to be done correctly. Phase 1 environmental. So there's a lot of expenses that goes on for that opportunity to get to the clothesline. And then you get to the clothesline, yes, it's like, oh, that's a nice payday. It reimburses me for like the last 4 months or 5 months of like searching and having that risk of that income to survive to the next 6-7 months. My mindset coach says, don't say survive, thrive for the next 5 to 6 months. So I'm shifting from survive to thrive
Awesome.
on that mind. So,
Well, Wayne, I just want to wrap us up here. What did you find easy during this process that you thought was going to be harder? And then what did you find harder that actually you thought was going to be a little bit easier?
yeah, so great question. It gets easier every time we do it. Like the systems in place, the contractors, the vendors, especially if you're focusing on a city or an MSA. For us, we're heavily focused on the Texas Triangle. So Dallas, Austin, Houston, San Antonio. And then even on that Texas Triangle, we really focus a lot on Houston. I love Houston. But in Houston, we have a lot of our vendor partners. We've got our solid management team. We have people, a lot of our investors are there. So it gets easier when you are focused on an area and you've done multiple deals. The broker relationships come easier, the lenders, et cetera. So that does help and does become easier on this. By that point, I think this is probably our 4th or 5th property. No, maybe not all multifamily. We've done RV storage and some retail and a build-to-rent community, but your systems are in place by the time you're, your 3rd, 4th, 5th, 6th property. On the hard part, I would say, the seller has a responsibility to, take care of their investors and, whatever their returns or whatever they need to get out of the deal, right? And we have ours. And sometimes when sellers and buyers are communicating directly, it can get tense. Start off really nice and sweet in the beginning, but as the deal moves forward, there's some maybe not disagreement, like there was no like major disagreements, but there are things that like, hey, things come up, right? And you have those conversations. Fortunately for us, it went smooth, but I could see the point where that relationship can sour, which impacts the deal to get closing. That's why if you have a broker and they're the ones bringing the deal, let them be the voice between the seller and the buyer. So that would be one of my lessons learned is I didn't really, if I'm doing it again, I think it would be better for me to just continue going through the broker, not initially getting on that call. The seller wanted that initial call to make sure I was legit, understand my background, liquidity, net worth, and all. I respect that. But as time goes on after that, once the sale agreement, let the broker professional who can handle different personalities be that person, right? So anyway, I didn't really think about the question before you asked it, but as a top of mind, let the broker do their job. That's what they're being paid for, and really what they're good at, right? They're good at being the therapist on both sides.
Wayne, thank you so much for sharing your knowledge and expertise with us here. Yeah. If people want to hear more about you and find you, where can they do so?
Yeah, so I'm extremely passionate about educating passive investors. So go to creipartners.com. We have an passive investor coaching program, a lot of free blogs and podcasts, et cetera. But you can also invest with us by going to creipartners.com, click invest with us, and like have a conversation with our team. If you are a co-sponsor looking to partner, I mean, it's a team sport. Definitely, go to that website, creipartners.com. That will have our contact information, and let's stay in touch. But Whitney, thank you so much for your time. It's an honor to be on this podcast and sharing our experience. It was a hard year to get any transactions done. And so, just thinking outside the box, creative, and working uh, with multiple people to get to closing, it's fun, but it can be hard work. And I'm really proud of what we did last year.
Awesome. Well, Wayne, thank you so much for your time here today. And we look forward to hearing about your future deals.
Absolutely, Whitney. Thank you so much.